All right, welcome to Talk Tickers. Today, we are digging into a real head-scratcher, IDEXX Laboratories. The company reported what looked like a fantastic quarter, but the stock completely tanked. So what's the real story here? Let's break it down. So management kicked off their earnings calls sounding super confident. I mean, they painted this picture of a company just crushing it at the end of 2025, with this incredible runway for growth ahead. On the surface, you'd think it was all good news. But Wall Street heard something completely different. Despite all that positive talk, the stock got hammered, closing down almost 5% for the day. And a sell-off like that, it tells you something really spooked investors. And that right there is the big puzzle we're going to solve today. You've got these strong results, but this really negative reaction from the market. A disconnect like this, well, it usually tells a much deeper story. So let's peel back the layers and figure out what Wall Street is so worried about. Okay, first things first, let's just look at the headline results from the quarter, because honestly, they looked pretty darn impressive. I mean, look at this. It was a clean beat. They sailed past what analysts were expecting for both revenue and earnings. This wasn't some messy, complicated quarter with a bunch of asterisks. The numbers were just solid, plain and simple. So if the numbers were that good, what was behind them? Well, the bull case for IDEXX this quarter, it really came down to two things, just flawless execution and some really powerful innovation. Get this, the company placed a record number of their premium instruments. We're talking over 1,900 of their new inVue DX analyzers in the fourth quarter alone. That's a huge number, and it tells you their customers are just snapping up their latest technology. And here's why that placement number is so critical. It drove an incredible 76% growth in their instrument revenue. This is the key leading indicator, right? Because every single machine they place today creates a stream of recurring revenue from consumables tomorrow. It's the classic razor and blades model in action. And maybe the most impressive part? They did all of this while getting more profitable. They expanded their operating margins by 150 basis points. Think about that. Even while investing heavily in the business, they became more efficient. That is not easy to do. So when you put this all together, the picture you get is a company that is absolutely firing on all cylinders. You have record placements, fantastic recurring revenue growth, expanding margins, and they even raise their guidance for the full year. This is basically the textbook definition of a beat and raise quarter. Okay, so if everything was so great, why on earth did the stock fall off a cliff? Well, it turns out the market completely ignored all that good stuff and latched on to one single detail, a little warning sign buried deep in their forward guidance. And it's so important to remember this about earnings reports. The market is always looking forward. A company's forecast for what's coming next can completely overshadow even the best results from the past. It is all about what's next. And there it is. This one sentence is the anchor that dragged the whole stock down. By telling the market they expect vet visits to decline, they basically waved a huge red flag about the fundamental demand in their core market. So what you had was a classic Wall Street battle. On one side, you have the bull case, incredible company-specific execution. And on the other, the bear case, a big macro-level fear that consumers are pulling back. And on earnings day, fear won, big time. So where does all of this leave IDEXX stock from here? All right, let's get to our verdict. We are assigning a market perform rating to IDEXX. Look, the company is executing beautifully. They are a best-in-class operator, but they're running headfirst into a wall of consumer weakness, and that's something even the best-run company can't completely control. Here's how we're thinking about it. Their innovation and their execution, that's real, and it provides a solid floor for the business. They've also proven they can manage costs. The big problem, is that vet visit headwind. It's a major roadblock that just caps the upside for now. Until we see signs that those visit trends are stabilizing, the stock is probably going to be stuck in a debate about what it's worth. Now, for those interested in a more advanced idea, you could look at what's called a paired trade. The core thesis is that the market is punishing IDEXX too much for a macro problem. So you'd go long IDEXX, betting on their superior execution, but at the same time, you'd short a general healthcare ETF to hedge against that broader weakness. The goal here is to isolate IDEXX's specific performance, with the next earnings report being the big catalyst. Ultimately, when you boil it all down, the story for IDEXX over the next few months comes down to this one question. Can their amazing innovation flywheel spin fast enough to outrun the macro headwinds? Can their tech win, even if the consumer is starting to pull back? That's what we'll all be watching.
This is not financial advice.